Welcome to our new video from Fiatico Benelux. This is not financial advice. This is just information so you can understand the market more. Let's start. In this episode we gon' dive deeper in the market. Let we begin with the different types of markets, dealers, brokers and exchanges for the buying and selling of assets. There are several different types of markets that facilitate trade. Each market operates under different trading mechanisms. The three main types of markets are 1. Dealers, also known as the over-the-counter market. 2. Brokers. 3. Exchanges. Dealer markets. A dealer market operates with a dealer who acts as a counterparty for both buyers and sellers. The dealer sets bid and asks prices for the security in question, and will trade with any investor willing to accept those prices. Securities sold by dealers are sometimes referred to as being traded over the counter, OTC. By acting as a counterparty for both buyers and sellers, the dealer provides liquidity in the market at the cost of a small premium that exists in the form of bid and ask spreads. In other words, dealers set bid prices slightly lower than the going market price and ask prices slightly higher than the market. The spread between these prices is the profit the dealer makes in return for assuming the counterparty risk. Dealer markets are less common in stocks, more common in bonds and currency markets. Dealer markets are also appropriate for futures and options, or other standardized contracts and financial derivatives. Finally, the forex, or foreign exchange market is commonly operated through dealers, with banks and currency exchanges acting as the intermediary connecting dealers with buyers and sellers. Of the three types of markets, the dealer market is usually the most liquid, because of the fact that the dealer's existence means that there will always be an available counterparty to traders wanting to buy or sell. Broker markets. A broker market operates by finding a counterparty for both buyers and sellers. When dealers act as the counterparty, the delay with brokers finding an appropriate counterparty results in less liquidity for brokered markets as compared to dealer markets. Traditionally, stock markets were brokered. Stockbrokers would try to find an appropriate counterparty for their client on the trading floor of a stock exchange. This is the stereotypical image that Wall Street used to be known for, with men and women in suits yelling at each other while holding pieces of paper representing their clients' orders that they are seeking to fill. Broker markets are used for all manner of securities, especially those with initial issues. A stock initial public offering, IPO, for example, will usually be launched through an investment bank which brokers the issue trying to find buyers. There is a similar procedure for new bond issues. Finally, brokered markets are also appropriate for tailored or custom financial products. Exchanges. Of the three types of markets, the exchange is the most highly automated. However, if no buyers and sellers are able to meet in terms of price, then no trades are executed. Because of the huge number of potential buyers and sellers trading through exchanges, such a situation is extremely unlikely and commonly only occurs in times of economic crisis. In practice, the large numbers of buyers and sellers makes a stock exchange virtually just as liquid as a dealer market. Although stockbrokers do still input orders for clients, the stock market is no longer truly a brokered market, having transitioned to operating as an automated exchange. Trades are executed based on order books that match buyers with sellers. The advantage of an exchange is the provision of a central location for buyers and sellers to find counterparties. Exchanges are used for all manner of securities, but are most appropriate for standardized securities such as stocks, bonds, futures contracts, and options. Exchanges typically specify the characteristics for securities that are traded on the exchange. Exchange-specified characteristics: contract or lot size, contract execution, trading months, tick size, delivery terms, quality. Delivery terms and quality are not commonly specified in stock exchange trading or bond trading. In a stock exchange transaction, all that is stated is the contract and tick size, as well as the execution, which is typically immediate. Contract sizes for securities or financial instruments are typically set to a minimum amount. For example, a stock might only be available for purchase in lots of 100 on a certain exchange. Tick size is commonly the lowest denomination of a currency. On US stock exchanges, the lowest tick price is 1 cent. A minimum 100 lot contract size under such conditions might then have a minimum tick value of $1, 1 cent x 100 shares per lot. Delivery terms and quality are more appropriately used in reference to commodity trading and to derivatives involving commodity-like assets. Gold and diamonds, for example, have qualities and ratings. Additionally, there must be provisions for potential delivery of the physical asset to the buyer or contract holder. Such characteristics are specified by the exchange and asset or financial instrument is traded on. The fixed income market. Fixed income securities such as treasury bonds are a type of debt instrument that provides returns in the form of regular, or fixed, payments and repayments of the principal when maturity is reached. These instruments are issued by governments, corporations and other entities to finance their operations. They differ from equity, as they do not entail ownership in a company, but bonds usually have seniority of claim in cases of bankruptcy or default. Fixed income securities are generally considered a safer investment than equities or other market investments, but do not usually offer investment returns as high as those that can be obtained through other investments. The term fixed income refers to interest payments that an investor receives, which are based on the creditworthiness of the borrower and current market rates. Generally speaking, fixed income securities such as bonds pay a high rate of interest, known as the coupon, the longer their maturities are. At the end of the term or maturity, the borrower returns the borrowed money, known as the principal, or par value, amount. The primary risks associated with fixed income securities concern the borrower's vulnerability to defaulting on its debt. In turn, this risk is incorporated in the interest or coupon that the security pays the investor. Additional risks involving the exchange rate for international bonds can be of concern, as well as the risk that changes in interest rates may increase or decrease the market value of a bond currently held. This is known as interest rate risk. Credit default risk arises if the issuer of a security is unable to pay interest and/or principal in a timely fashion. The probability of credit default risk occurring depends on the issuer's ability to meet their financial obligations and on their creditworthiness. There is a negative correlation between credit rating and yield. The lower a bond issuer's credit rating, the higher the yield that will be offered to compensate for higher risk. A change in the issuer's credit rating affects the value of their outstanding fixed income securities. There is a purchasing power risk associated with fixed income securities because the real rate of return on fixed income investments equals the rate of return minus the rate of inflation. During periods of high inflation, the real rate of return on fixed income investments may become negative. Bond pricing. The price of a bond depends on several characteristics that apply to every bond issued. These characteristics are as follows: coupon, or lack thereof. A bond may or may not come with attached coupons. A coupon is stated as a nominal percentage on the par value of the bond. Each coupon is redeemable per period for that percentage. A bond may also come with no coupon. In this case, the bond is known as a zero coupon bond. Zero coupon bonds are typically priced lower than bonds with coupons. Principal, par value. Every bond comes with the par value, the principal amount that is repaid at maturity. Without the principal value, a bond would have no use. The principal value is to be repaid to the lender, the bond purchaser, by the borrower, the bond issuer. A zero coupon bond pays no coupons but guarantees the principal amount at maturity. The interest paid on a zero coupon bond is delivered in the form of the bond price being less than the principal amount that will be paid at maturity. For example, a zero coupon bond with a par value of $1,000 might be available for purchase for $900. When the purchaser of the bond receives the $1,000 par value on the bond's maturity date, they have, in effect, received approximately 10% interest on the bond. Yield to maturity. Bonds are priced to yield a certain return to investors. A bond that sells at a premium, where price is above par value, will have a yield to maturity that is lower than the coupon rate. Alternatively, the causality of the relationship between yield to maturity and price may be reversed. A bond could be sold at a higher price if the intended yield, market interest rate, is lower than the coupon rate. This is because the bondholder will receive coupon payments that are higher than the market interest rate, and will therefore pay a premium for the difference. Coupon periods to maturity. Bonds vary in the number of coupon payments that occur until the bond matures. More frequent coupon, interest, payments are considered more desirable and typically increase the price of a bond. All else being equal, the following statements about bond pricing are true: a bond with a higher coupon rate will be priced higher. A bond with a higher par value will be priced higher. A bond with a higher number of periods to maturity will be priced higher. A bond with a higher yield to maturity or market rates will be priced lower. An easier way to remember this is that bonds are priced higher for all characteristics except for yield to maturity. A higher yield to maturity results in lower bond pricing.